Good morning, everyone. Thanks so much for joining us. Starting off your morning right, talking about the hard insurance market. I'm going to give everyone just a couple seconds as people are coming in. Looks like everyone's filtering in okay. Well, welcome everyone. My name is Cassie Hopkins and I help run the webinars here at Hausman Group. I'm just here to give you a brief introduction to our webinars, and then Alex and Jake are going to take it away. So first things first, this webinar is recorded, which means if you can't join us for the whole thing, or maybe you're watching this as a recording, or maybe you can only watch just a little part of it and need to come back to something, you can always be able to do that with the link that we will send out in an email. And you will also get a copy of the presentation slides as well. We are going to have a Q&A session at the end of the webinar, so you can type in your question at any time during the presentation, and Jake and Alex will answer it at the end of the webinar. If for any reason your question is answered, we're still going to just chat about it and be able to give that. So don't be afraid to send in any questions you have. Without further ado, I will introduce Alex Bauer and Jake Dowell. So Alex joined Hausman Group in 2012. Although he primarily works in real estate and hospitality clients, he also enjoys working with construction and contractor accounts. He's quick to break down complex concepts and to communicate how clients' insurance programs fit within their agreements in a timely manner. He is regimented and a consistent advisor who always has the desire to learn new things and how to better apply solutions to the businesses he assists. Because of his passion for education, Alex has an exceptional amount of tools and resources at his disposal to solve problems, such as his CRM, CIC, and CISR designations. Jake Dowell joined Hausman Group in 2019 as a property and casualty consultant. He maintains an incredible reputation in the community and the insurance industry and wanted to join Hausman Group to be a part of our culture. Before joining the team at Hausman Group, Jake worked primarily in personal lines as well as working with business owners. He strives to develop lasting relationships built on trust and transparency, and he is passionate about prioritizing his clients. Jake ensures that everyone uses any resources available at his disposal to find a solution to any problem his clients encounter. He takes pride in knowing their needs are met and their businesses are insured properly. Welcome, you two, and thank you so much for being here.
Thank you, Cassie. Happy to be here.
Thank you for the glowing introduction, Cassie. Thanks for starting your morning with us and talking insurance, everybody. This is going to be a wild ride, so why don't we get right to it? All right, so here we are. So a hard insurance market. Let's just start right there with our title. What is that? Well, it's the upswing in the cycle of the insurance market where costs are increasing, capacity is decreasing, and there's just greater scrutiny from the insurance companies on all of the businesses that they're insuring. So during a hard market, not every single type of insurance gets hard or soft at the same time. So we will primarily be focusing on property today because that's the line that's having the most trouble. If we were talking about a hard market maybe 2 years ago, we would have been focusing mostly on cyber, in 2020 and 2021 when everyone all of a sudden was at home, working from home. There were cyber vulnerabilities that just went on fire. And then once all the security kind of caught up, the insurance market has calmed down. But property is where we're having the most issues. So we'll address that today. And, one of the big reasons for this is that insurance companies are also in the business of making money, and they're struggling to do that right now. The combined carrier loss ratio last year in 2022 was about 105%. And I'll just note that we use the term carrier and insurance company sort of interchangeably, so apologize if we sort of slip back and forth between our industry jargon there. So a loss ratio at the most basic level is claims paid out divided by premiums taken in, and then the combined ratio is claims paid out plus expenses divided by the premiums collected. So as you can see, in terms of claims and claim expenses last year, $105 were paid out for every $100 of premium collected. So as a result, the market is hardening, and the insurance companies are needing to collect more premiums and be more careful about which premiums they're collecting to try to recoup from that. So how did we get here? Like I said, we're going to focus a lot on property today. The big reasons for property having trouble is the ongoing supply chain issues that have been playing out since the beginning of the pandemic in 2020, in that materials are more difficult to source and to receive, and the costs of them are increasing. And so it's just more difficult to get the things that you need to build something. And then part of that too is the cost of labor has increased. So labor in the construction industry is up quite a bit, and it's taking longer to build things because of the supply chain issues, the costs and the labor costs. And of course, major weather events. Obviously, those are some of the biggest drivers in property losses these days.
And then if we switch over to the liability coverages side, that's being affected by a number of different areas as well. Part of it being major jury verdicts being handed out by juries. Sometimes we call these nuclear verdicts. And nuclear verdicts happen when a claim goes to trial and a large unexpected financial penalty is awarded, and it's usually over $10 million. We also have an increase in anti-corporate sentiment, which is, there's really an increase in public perception, really, that businesses can afford the cost of any damages, and the overall public sentiment towards large businesses and corporations is really deteriorating. We also have medical inflation that we're dealing with. Healthcare inflation has outpaced all other sectors since the year 2000, and that's an ongoing issue that we're always going to be working through. We also have cyber attacks, which Alex had mentioned earlier. Those, again, since the pandemic has really increased. We're seeing a lot of ransomware attacks as well as social engineering, which is the practice of deceiving or manipulating people into sending information or assets to the wrong people. We also have the catastrophic or CAT events. That's the major weather events. We'll be getting into that in a minute here, and as well as the reinsurance market, which drives the rest of the insurance market, and we will also get into that.
Yeah, reinsurance is basically insurance companies buying insurance on their losses. So it has to be a big loss for it to get to that point, and it's gotten to that point quite a bit. So we'll have a slide on that later. So yeah, Jake, let's jump right into these catastrophic events. What do you say?
Absolutely. Yeah, the catastrophic event, like I said, is an event it's a single event with greater than $1 billion paid. We're talking a lot of the disasters, the floods, the hurricanes, the wildfires, and other natural disasters that we have in the Midwest, with tornadoes and hailstorms, all increasingly common and devastating. And years of costly disasters like these have compounded losses for insurers, which are driving up the cost of coverage overall, especially when it comes to commercial property policies. As we can see here, there was 18 different events in 2022 with $165 billion paid. And just a year before that, we had 20 events with $145 billion paid.
Mm-hmm. Yeah, so those are big numbers compared to this average that you're seeing here. In the last 42 years, I guess, we've averaged about 7.7 such events per year. And of course, with 20 and 18 in the last 2 years, and we're already up to 7 as of May 8th this year, you can see how that would skew the average up. So in previous years, it would be less than 7. In fact, in the last, I just looked this up with NOAA. It's the last 8 straight years we've had 10 or more of these events in each year. So as you can see, it's increasing quite a bit. Now, typically the conventional wisdom here in the insurance industry has been like, most of these things happen on the coasts. In the Midwest, we're insulated from this. In the Midwest, we have a lot of very strong regional insurance companies or insurance carriers. And since they largely did not have presence on the coasts and in these more challenging states, we in Wisconsin and the Midwest have felt somewhat insulated from these major events. But in the last 2, 3, 4, 5 years, especially, a lot of these things have been happening in the Midwest and where they would not have been expected to happen before. Like we've had tornadoes in Alabama, we've had, lots of thunderstorms. Well, I'm probably burying the lead. We'll get to those in the next few slides, but, and then, we're going to keep hammering this point home here. These catastrophic events, and apologize if we sound like we're repeating ourselves, but it's a pretty major issue right now. When you have a lot of catastrophic events and a lot of insurance companies are paying big dollars for property claims, they're putting claims in with their reinsurance companies, and the reinsurance layers are paying, and that has a ripple effect across the whole industry. Like I said, yeah, the latest data from the National Oceanic and Atmospheric Administration, NOAA, it's not a person, as of May 8th, the latest data we had available, there have already been 7 of these large events. Here are some examples from last year. Hurricane Ian, obviously we all heard about, 55 billion insured losses, estimated over 115 billion total. There's some severe thunderstorms and derecho storms across the Midwest that have had several billion. Jake, did you want to touch on those derechos real quick?
Yeah, the derechos are really, we think of tornadoes and the severe thunderstorms and hail around here. The derechos have been increasingly common as well. And the difference between them is that they are these widespread damaging wind events that they come from clusters of severe storms and that windstorms leave behind. The winds can be as strong as 60 to 100 miles an hour in extreme cases. And when we think of a single severe thunderstorm, it might produce an area of damaging winds only a mile or 2 wide and perhaps a few miles long. But these derechos, they produce damage tens of miles wide and hundreds of miles long. So they're impacting a much, much larger area.
Do those come on the tail end of a severe thunderstorm, or do they lead it?
They're coming on the tail end.
Yeah. So you might have lightning and then hail and then severely damaging winds coming from the same weather system.
Absolutely.
Yeah. I think these maps will maybe be a little bit more impactful than us talking about it. So this first page here is 2021. Okay. So, you can see a lot of wildfires. Those were all very, very well publicized. There was some flooding in California, drought. But just look at this huge swath of the middle of the country and how many of these things were happening here. So I think severe thunderstorms, July 8th to 11th, that was on that previous slide. There was another big storm here, North Central. Here's derechos and tornadoes across Missouri and Iowa. Some more severe weather here, Texas and Oklahoma. And then cold snap in February in Texas happened, hailstorms in Texas. So, as weather patterns have been changing and events are happening that were not happening much, if at all, for a long time, it's been hard for the actual actuarial and climate models to kind of keep up with, or have the insurance companies be able to keep up, because the models haven't caught up to what's happening yet. I mean, that freeze in Texas in February of 2019, everyone remembers the power went out. That was a major event. And of course we have flooding in Louisiana and hurricanes, as you might expect, but tornadoes down here, Alabama and Mississippi, not really thought of as tornado country. So just lots of stuff. And then last year,
yeah, it's more of the same from 2022. You still have your hurricanes and some wildfires that we expect and we hear about, but we also have more hailstorms, and we have the derechos as well as, we have our droughts out west. So all of these things, some of these things we expect, but because we hear them on the news, we talk about them. But again, we want to look at the Midwest and the number of these major events that are happening in the Midwest that, as Alex said, was not the case a number of years ago.
Okay. Well, we've hit on a lot of weather stuff. Let's jump back to some of the issues we were talking about earlier with materials costs and supply chain issues. So what we're looking at here, unfortunately, is last year. This data is from a year ago because the labor statistics hasn't published the new data yet for these things, but you can see how much some of these things were up. I think the one that people heard the most about was lumber, 30% up year over year. And so all of these things are things that are needed to rebuild a building. And so when the cost goes up, the cost of the claim goes up, and that affects that carrier loss ratio.
Yeah, and if we're looking at these increases, these things also cause difficulty for contractors to accurately bid their jobs and not only bid them, but then be able to make their bids last for a certain amount of time, because with the changing of these prices, the fluctuation of these prices, their bids might only be good for a much shorter period of time. And like Alex said, the lumber was one that we were always talking about. It has since come down a bit. Copper, as we can see down there, is one of the biggest ones. That has come down about 12% in the last year. And steel prices, U.S. steel prices have been still on an uptrend due to domestic steel makers raising prices and then low import levels. And the consensus really is that the cost of most materials are not going to return back to the pre-pandemic levels this year, but they should come down, or at least not increase as dramatically as they have been. Yeah,
we're hoping for at least a stabilization as we kind of get out of the worst of the pandemic and everyone gets back to maybe closer to normal work patterns.
Supply chain issues, we ask, how does that really affect the property claims? Well, the increased cost of individual claims due to the material cost and the supply chain delays, it delays the completion of work due to lack of materials and labor. And the U.S. Census Bureau said the sectors that experienced the greatest supply chain difficulties was manufacturing, construction, and retail. And global events such as the ongoing Russian-Ukraine conflict have far-reaching impacts that can also further exacerbate supply chain issues. And the pandemic also, it caused a major disruption in America's labor force. We've all probably heard the term the Great Recession, and in 2022, more than 50 million people, workers, quit their jobs, many of whom were in search of improved work-life balance and flexibility, as well as increased compensation. And on the labor side as well, Associated Builders and Contractors came out with an analysis early in 2023 stating that in order to meet demand in the construction industry, contractors will need to hire 546,000 workers in 2023, and that's in addition to the industry's normal pace of hiring. So with these, you also have the increase of cost of business interruption portion of the claim as a result of the delays, because as these projects are delayed and they take longer, the insurance company is still paying the business interruption for that company as they cannot operate as normal. So those get dragged out, and the cost of the claim just increases that much more.
Yeah, great points, Jake. And then another thing to think about too is in a place like Madison, especially if you have a hailstorm that hits the isthmus, all of a sudden everyone is dealing with needing to get their roof and their siding repaired from this hail claim. All of these contractors have all of their regular work and bids out, and then all of these insurance companies are scrambling to hire contractors to fix all of this damage from this hailstorm, and that can increase the delays even further and drive up costs. So the business interruption is a huge portion when things take a lot longer, that they're just, insurance companies are having to keep paying. So let's move on to reinsurance. So we've been talking a lot about just the massive amount of claims and the size of these claims, and that a lot of primary insurance companies are having to put in claims to their reinsurance companies to help pay for these things. So again, what is reinsurance? More or less, the most basic way to describe it is an insurance company buying insurance on their claims. So there's two types mainly. We have treaty reinsurance. So this is basically a company taking out a reinsurance treaty or policy on their entire book of business, their entire losses. So an example might be a company keeps the first 10 million of any one loss in-house, and then their reinsurance treaty would kick in to pay any losses above 10 million. Reinsurance treaties may specify certain types of clients that they can take, like, or parameters on building height or building value or liability limits. It sort of covers a lot of things, but it's more or less the insurance company insuring their book of business in a general way. Facultative reinsurance is reinsurance on a specific risk. So a company's reinsurance treaty might say, well, you can put up $5 million of umbrella or excess liability. The insurance company may be able to provide a $10 million umbrella liability policy to a client, but they would have to then go and purchase facultative reinsurance on that second 5 million. And so that comes at an additional cost to the insurance company, which then certainly is passed on to the policyholders. And then, yes, how do catastrophic events affect reinsurance? Well, that's what we've been talking about all morning already, is these are all massive events, and insurance companies are paying massive claims out. And when that happens, they have to have their reinsurers pay, which trickles down to everyone else.
And the results of this is, really when these events occur frequently or they're particularly severe, they can deplete the capital reserves of the reinsurers, so which makes them much more cautious about assuming additional risks. So that higher claim payments can result in reinsurance carriers reassessing those risks and their pricing. So to compensate for these increased claims, they might need to adjust their premiums and their underwriting terms for future policies, which impacts their competitiveness in the market. And when reinsurance capacity is reduced, it can affect the primary insurance carriers and their ability to obtain adequate reinsurance coverage. So this might result in higher premiums and reduced coverage, which I bet you can assume. So ultimately, the higher rates and the lower capacity is pushed down from the carriers to the policyholders, like Alex just said. And on the property here in 2023, we're seeing an increase of 15 to 20%.
Yeah, the 15 to 20% is pretty much across the board for all commercial property. Just as a baseline, more challenging risks can see even more than that. So if you out there as a policyholder are, talking to us, your agent, and we're delivering this 20% increase, it's not you. You're not being targeted by the insurance companies. It's just the entire industry is a little bit underwater and trying to catch up. Real quick, just who are the reinsurers? Here's like a list of a few of the bigger ones, just to give you kind of a flavor for what these companies are. You can see Berkshire Hathaway, Lloyd's of London, Swiss Re. These are familiar names and are obviously very large entities. So that's kind of how this ecosystem goes. All right.
And I know we sound like a bit of a broken record here, but it's just the world we live in right now. And this isn't supposed to be a complete doom and gloom presentation, but it's really just to educate and then give some insight into how to prepare for these and mitigate some of these risks. But again, we're going to see reduced capacity and limits and reduced appetite for certain types of business. You're going to see more strict underwriting, and you might see reduced appetite for certain types of business. And that's right now, as we said, that's property in general. That's definitely apartments. We're seeing different carriers pull back on their appetite for writing habitational apartments, and especially if they're mixed use and they have retail on the first floor, and that retail happens to be a restaurant. That's been a tough situation for a lot of insurers. We're also seeing increased retention on the policyholders to take on and separate wind hail deductibles. So expect to see some premium rates increase in 23 and 24. Like I said, 2023, we're seeing 15 to 20%. And unfortunately, we're still looking into more increases in 2024.
Mm-hmm. Yeah, and before I touch on interest rates here, I'll just give a brief example of why apartments especially are challenging to insurance companies. So one of the ways that they look at it is that because there's a kitchen in every single unit, somebody is cooking something and there's a fire going, possibly in 30, 40, 50, 60 individual rooms in a building, controlled just by individuals that the insurance company doesn't exactly know who they are and what they're doing. So apartments especially are viewed as a greater property risk, partially because of that. And that's why that in particular is causing problems in the apartment market specifically. We added a point here about interest rates. As we've been seeing, the Fed has been increasing interest rates steadily over 2022 and into 2023. The most recent time, just the other day, they opted to leave them where they were. So we might be seeing a slowing of the interest rates. It's important in terms of companies taking on new loans to start new businesses or to do new construction projects, things like that. But it also is important to go back to one of the very first points about the insurance companies' industry-wide combined loss ratio at 105% is that insurance companies take the premium dollars they collect and invest some of it. And when interest rates are higher, they can make some investment income off of the premium dollars that they're holding in their investments. So like in the 1980s, for example, when interest rates were in the double digits, an insurance company might have been able to sustain a 102%, 103% loss ratio if they're making 6, 7, 8% on their bond investment income. With interest rates at or near zero for the last 10 plus years, that avenue for income for the insurance companies has been much reduced. Now, it's obviously a longer tail. If the interest rates are up at 6, 7% today, will they stay there? That remains to be seen. And it will take, obviously we're not financial guys here, we're insurance guys, but so I can't speak too specifically about it, but it may take a year or 2 or 3 to see any results of that investment income. And perhaps if the rates are sustained and insurance companies can get a little bit of relief, then maybe we'll see some effect in the actual property rates. So as part of this, as part of the expectations of the insurance companies is like, not only are they increasing rates and getting more premium, they're increasing their underwriting scrutiny. Like they're looking at each business that they insure on a much more detailed level. And again, since we're mostly focusing on property, this is a lot of what we're going to talk about here. So property valuations. So for a long time, we would say, okay, this building cost $5 million to build, and then each year we'll apply roughly a 4% inflationary factor to keep the replacement cost up. Well, obviously, as we've been talking all morning about supply chain and material costs and labor costs, the cost to build that building has increased substantially in the last 2 years. So insurance companies are putting pressure on policyholders to make sure that the property valuations on the policy are adequate to replacement cost. They do this to ensure that they are collecting the appropriate premium for the risks that they're insuring. And then one of the tools to help our policyholders mitigate some of that risk for themselves is to blanket property limits, wherein a policyholder may own several buildings, and the total value of all of those buildings is added into one single limit that's available for any one claim. Some of the insurance carriers are now resistant to blanketing property limits to reduce some of their exposure, so to an underinsured building. And then a lot more loss control inspections. So the insurance company will send out their inspector and look at the maintenance of the property, look at the how it is run, and suggest things for repair. So if there's something in the way of the electrical panel, cracked sidewalks, anything that you can think of that might be a hazard that could lead to a potential loss, they're gonna look for it and then ask the policyholder to comply and repair these issues. Another issue we're seeing is geographic concentration of property. So there are insurers that insure a large number of properties in Dane County or on the Isthmus in downtown Madison. And because they have such a large amount of value insured in a small geographical area, they're looking to not add more to their book of business in that geographic location. Or also more on a more micro level, when looking to take on new business, some of them do not want to add a large number of properties within a certain number of feet from each other to reduce the risk of perhaps a fire that is affecting one building jumping to another building that they also insure, and thus increasing a loss. And then a large issue for our policyholders from a dollars standpoint is the application of wind hail deductibles separate from your usual property deductible. And sometimes this will be in a flat dollar amount greater than your usual deductible, but more often it is a percentage deductible, which is a percentage of the building limit. So if you have a $10 million building and they apply a 1% wind and hail deductible, that all of a sudden you have a $100,000 deductible for wind and hail losses. And if you're used to carrying maybe a $5,000, $10,000 property deductible, that's a big hit to your pocketbook when that hailstorm blows through and you need a new roof and siding.
Yep, and then, excuse me, the builder's risk market still remains kind of a tale of two sides here. The non-combustible marketplace really remains competitive and steady. But when we get to the wood frame market, that continues to present some challenges here. There are fewer insurance companies willing to write the builder's risk on the wood frame construction. And buildings under construction or renovation are already susceptible to loss. So some carriers are reducing their capacity. We're seeing needing to get multiple carriers in on some higher valued builder's risk projects. And really what you're seeing is also, there's a number of different types of losses that we're seeing mostly. It's theft is a major one. You're also seeing water damage as well as fire. And due to those three things, those items specifically, you're seeing more monitoring service being required on the job site to protect against those fires, waters, and also provide motion detection after hours. Some of these things we're seeing is you're going to see site perimeter fencing around any job of any value. As the insurable value of the project increases and you're getting in a little bit higher, you're going to see other things like rate of rise detectors required, which are measuring the rate at which air temperature changes. And alarms can respond more quickly to measuring temperature changes than by measuring temperature levels in a room. We're also seeing water flow valves on domestic fire and water lines, fire water lines, and there's a number of other ones, but these are just some of the ones we wanted to highlight here today.
And I would add to that point is all of these additional security requirements that Jake just mentioned need to be in place, like to even secure a builder's risk policy. You need to have all of this security in order to even get the insurance anymore, which was not the case even just 3 years ago. Did you have any specific rates on frame builder's risk, Jake?
Yeah, when we're getting into the $10 million range for insured value, we're still in that 40 cent range, which is still up quite a bit from past years. And as you get higher into that $15 million limit, which is already over most of the carriers' limit of capacity of what they're willing to write, you're getting into that 45 cent range, and then if you get above 20, you're closer to that 50 cent range, which is it's a difficult thing to wrap our head around. That just as a developer, as a you're trying to get a project going, and these prices just keep going higher and higher, and it's one of those that we just need to be in contact with your agent and really be prepared for it so you can budget for it.
Yep. Speaking of budgets, so we've been all doom and gloom of insurance is going crazy. What can you do to help yourself kind of not feel the squeeze of this as badly? So it's time to talk about some risk mitigation. So again, mostly focusing on property here is our biggest issue in the insurance world right now, but we'll talk about liability as well. First of all, obviously maintenance. I mentioned the loss control folks from the insurance companies are going to come and recommend maintenance, but it's better to be proactive and keep a schedule of exactly what you've done at all of your properties, identify potential hazards, look at depreciation schedules and average lifespan of certain aspects of the building, like how long does your concrete last, when do you need to replace your furnaces and your electrical panels, and all of that sort of thing. And keeping really good records of that is very helpful, because when we as the agent are talking to the insurance company underwriters about our clients, we want to be able to tell a really positive story, and having these records of maintenance is a really good story to tell to the insurance companies to say, hey, this is a really good client for you to take on. Taking on a higher deductible usually reduces premium, as we know, and then funding for those deductibles with your premium savings and any other ways that you can keep those funds funded is good. If you have the funds in the balance sheet to take on that higher dollar amount risk. You can also get certified replacement cost appraisals on your properties to verify that the limits are adequate. Right now, as I said, the insurance companies are really pushing adequate building values, and they're using most of them use the same software, and it presents a replacement cost estimate, and sometimes it's not always accurate. So having your own appraisal that you can use to I don't want to say fight the insurance company, but have your own data to bring to the conversation when discussing limits with the insurance company is valuable. One of our agency standards for property insurance is the agreed amount endorsement. What that does is suspends the co-insurance provision, meaning that if the agreed amount endorsement is added to the policy, the insurance company cannot penalize the policyholder for having an underinsured value at the time of loss. So it's just a protection to the policyholder that says, insurance company, policyholder, and the agent, we agree that this is the dollar amount for this building, and then the insurance company cannot reduce a claim payment if it ends up being low. And this is in a partial loss, of course. They won't pay more than the insurance limit. And then budget forecasting, get talking with your agent early. This year, we have been trying to really start on our renewal planning 4, 5, 6 months, before renewal dates, because especially for apartments and commercial property where you are negotiating your leases with your tenants, you need to be able to expect how much more your costs will be in case you need to increase rents or anything of that nature. So make sure you know when your renewal date is and get talking to your agent, to me and Jake and everybody else here really early. And then lastly, the business income insurance. This is one where it's difficult to really get the correct dollar limit or monthly limit, depending on how the program is structured. So as we discussed, claims are taking longer. So a lot of times a business income insurance will be on a 12-month actual loss sustained basis. So the company will pay whatever your loss of profit is for 12 months. If a construction project that took 12 months, maybe 2 years ago, might take 15, 16 months now. So make sure if you have monthly limit on your business income that we increase it to 18 months or 24 months, just to make sure that you have enough time if you have a loss, or if we have it structured with a dollar amount that we are taking into account the longer period of restoration and increasing that dollar limit to account for it. Now let's get off of property a little bit. We've been hammering it too much. What do you think, Jake?
Yeah, I agree. And in the liability, cyber, and workers' compensation lines, we recommend in implementing employee training programs to reduce these liability and injury exposures. It's really, we like to say, managing your risk instead of just buying insurance. And it's putting these programs in force to really enforce that the company's culture is a safety culture. We also recommend documentation and maintenance and incidents. We document everything you can so that you have that if something was to, if a claim was to come up. Fleet management programs, if you have a heavy fleet, that is a standard quality control practice, as well as driver acceptance programs. Really creating a driver acceptance program to create a criteria around who is an acceptable driver for your company. The insurance company might say that they think somebody might be not a great driver or unacceptable driver, but we really recommend on your own end to do that. Run the MVRs for the company and find non-driving roles for employees if they have an unfavorable MVR. Again, this shows the insurance carrier that you're managing your risk, as well as it also puts you in a position where you can't have an employee come back to you and say, well, how come I can't do this and so can do this? This is your criteria for your driving at your company. Another one is the IT and cybersecurity. We all know that this is becoming more and more prevalent. It's not new anymore. This is something that is here and it's here to stay. We recommend, we are excited to be partnered with Arctic Wolf, create a cyber jumpstart program and scans for open doors and then closes those doors. And it also they help you create an instant response plan. If you do have a cyber incident, I hope you have a cyber policy in force to cover you, but it's important to have a cyber incident response plan so everybody's on the same page and knows what the action is next to take. And that will greatly reduce some of the chaos of these incidents.
Well, with that is all that we had for the slides. So I think we'll have Cassie pop back on here, and if anybody has questions, please send them to the chat.
Yes, thank you guys so much. That was a very enlightening presentation. As someone who works adjacent to insurance, but isn't always working in insurance, I didn't realize so many factors were causing this hard market. So I learned something new today. So as Alex said, this is our Q&A section. So if you have any questions for Alex or Jake, you can just type them into the chat feature, or you can use the Q&A portion as well. I'll give you a couple minutes here if you want to ask some questions. There was already one that came in while you guys were speaking, and that is, here it is. I have heard I should start my renewal early in a hard market. Is this true?
Yeah, I mean, I think we just touched on that in the last couple of slides is, yeah, we've been trying to start by, at the latest 3 to 4 months ahead of the renewal date, but even 5 is a good thing to do right now. Depending on your type of business. Some underwriters won't look at a renewal until 60 days beforehand, but that's only certain lines of business. So if you know your renewal is coming up on October 1st, it's already June 15th, like we should already be talking.
Good to know. Thanks for answering that. How much of a deductible increase to account for inflation can I make if we have a low risk appetite?
I think your deductible depends. If you have a low risk appetite, I don't know that you want to be spending a lot of money on your deductible either, but I think that's a case where it's individual for each individual company. But I think our job is to go get options for you, and we can present them to you, and you can look at different 5, 10, 25 or $50,000 deductibles and see what that does to your premiums, as well as then you can also start setting aside a fund for these deductibles so that if something was to come up, you have that money set aside for it.
Yeah.
Good answer. Something you guys didn't mention is consumer needs changing. Do you see this making the hard market go longer?
Consumer needs.
I'm guessing they mean in terms of, I'm guessing this would be in terms of materials, maybe labor materials.
Yeah, I think we're still seeing a lot of the same materials being needed. People are still choosing to build with lumber, regardless of the prices and the prices to insure them. But I think we're still seeing a good, healthy mix of non-combustible and lumber being used, as well as all other construction.
Yeah, I would add we're just starting to see this mass timber type of construction become more popular. I think, Jake, actually you probably have experienced that more than I have. But I think you're right, with people have been choosing to build wood frame even when the cost of lumber was at its highest in 2021. So it seems like we'll still be seeing the same types of construction, and it may not prolong the hard market, but mostly the losses will prolong the hard market more so than the needs of the consumer and what's being built.
Very nice. Those are all the questions that came in. If you think of a question after this webinar is over, we will be sharing Alex and Jake's contact information in the follow-up email. And just a reminder that this webinar is recorded, and you will get a link to the recording as well as a copy of the presentation slides. And that'll be sent out to everyone who registered. Once this webinar is over, there is a short survey we're really hoping you can fill out. It just lets us know what you thought of the webinar, and also gives you an opportunity to let us know what kind of topics you want to hear about in the future. For instance, next month, we will be kind of talking a little bit more about the hard market, but we're going to be taking it from the bonds perspective. So if that is something that interests you, just follow us on LinkedIn, and that is where we kind of promote all of our events and webinars. Thank you so much, Alex and Jake, for doing this webinar. We really appreciate it. And thank you all for joining and spending your morning with us.
Thanks, everyone.
Thank you.